Have you ever wondered why interest rates make such big headlines? Interest rates affect almost every part of our economy, influencing things like the cost of loans, mortgages, and even the prices of everyday items. They're a key piece of our financial system, but they're often a mystery to people who don't work in finance. In this video, we'll break down what happens when interest rates go up or down, and why these changes impact everyone, not just big companies or policymakers, but also everyday people like you. Let's start with the basics. What exactly are interest rates? In simple terms, an interest rate is the price of borrowing money. Think of it as a fee you pay for the convenience of using funds that aren't yours. If you take out a loan, buy a house with a mortgage, or use a credit card, you'll pay an interest rate on the amount you borrow. Interest rates are usually expressed as a percentage, and financial institutions set them based on a baseline rate determined by central banks like the Federal Reserve in the United States. These central banks have the power to adjust interest rates up or down to help manage the economy. While there are various types of interest rates, like short-term and long-term rates, we'll focus here on central bank rates because they set the foundation for most other rates in the economy. So, why should interest rates matter to you? The short answer is that they shape the cost of borrowing and the incentives to save, which directly impact our everyday financial choices. For borrowers, higher interest rates mean that loans become more expensive. If you're buying a home with a mortgage, for example, a rate hike could significantly increase your monthly payment, which might affect your budget or lifestyle. But when interest rates are low, loans become cheaper, encouraging people to spend more on big purchases like homes, cars, or even vacations. Savers are affected too. When interest rates rise, savings accounts and certificates of deposit tend to offer higher returns, providing people with more incentive to save. On the other hand, lower rates make savings accounts less attractive because they yield lower returns. Interest rates also influence our spending habits. Higher rates can discourage people from spending and borrowing, while lower rates can encourage it. And interest rates are closely tied to inflation, which is the rate at which prices rise across the economy. When rates are high, inflation tends to slow down because people and businesses reduce their spending. But when rates are low, spending often goes up, and inflation can increase if demand for goods and services starts to exceed supply. When interest rates go up, this creates a ripple effect across many areas of the economy. For individuals, it means that borrowing costs go up, so payments on things like mortgages, car loans, and credit card debt increase. This can strain people's budgets and might lead them to cut back on other spending. Businesses are also affected. Many companies rely on loans to expand or fund their operations. When borrowing costs rise, businesses might hold off on growth plans and invest less in new projects. This can lead to fewer job opportunities or even layoffs. The stock market also responds to interest rate hikes. When rates go up, returns on safer investments like bonds often become more attractive compared to stocks, which can cause some investors to shift money out of the stock market. This may lead to lower stock prices as companies face higher borrowing costs and potentially slower growth. For instance, if interest rates go up, a family planning to buy a home might find their mortgage payments are suddenly more expensive, which could make them rethink their plans. Similarly, a small business owner might decide not to expand because higher loan costs make the project less profitable. When interest rates go down, on the other hand, the effects are generally positive for borrowers and investors. Lower interest rates mean cheaper loans, encouraging people to make big purchases, like buying homes or cars. Companies might also borrow more to fund growth, leading to new investments, more jobs, and potentially higher wages. The stock market usually reacts positively to lower rates because businesses and consumers alike have more money to spend, and stocks become more attractive investments relative to lower yield bonds. This often results in higher stock prices as investors expect stronger company profits. However, low interest rates can increase the risk of inflation. When people and companies are borrowing and spending more, demand for goods and services can increase quickly. If supply can't keep up, prices may rise, which impacts the cost of living for everyone. For example, if rates drop significantly, a family might be able to afford a larger home thanks to lower mortgage payments. Or a business might expand sooner than expected, hiring more employees and boosting the local economy. Yet, if inflation rises too much, those benefits can fade as the prices of goods and services increase. For everyday people, understanding interest rates is important because they influence many of the financial decisions we all make, from buying homes to managing debt and investing. If you're in the market for a house, keeping an eye on interest rate trends can help you time your purchase to save thousands of dollars over the life of your mortgage. If you're managing credit card debt, lower rates could mean smaller monthly payments, which could free up cash for other expenses. Investors also closely watch interest rates because they impact stock and bond markets. When rates are low, stocks tend to perform better, while bond yields may decrease, making stocks a more attractive option. But when rates rise, bonds often offer better returns and stocks might struggle. In summary, interest rates are more than just an economic term. They're a powerful tool that affects nearly every part of our financial lives, from the cost of borrowing to the value of our savings and investments. By understanding how interest rates work, you can make smarter financial decisions whether you're buying a home, managing debt, or investing for the future. So, how have interest rates impacted your finances recently? Let us know in the comments below, and if you found this breakdown helpful, don't forget to like, subscribe, and share.